Welcome, friends. Continuing our session one, I see Ashish Gupta, Deputy Director Board of Studies, welcomes you all in this session for the paper Advanced Financial Management, Paper 2, Group 1, Final Level. So, students, we are continuing with our previous lecture, that is first chapter, Financial Policy and Corporate Strategy. There I was discussing some numericals. So I shall continue the same, of course. So let us see what we have covered, and we have just all these we have covered till now. Now I am coming to the question number. I think we have solved up to the question number second. Second, we have solved it. Now I am today's first session, first part. I will uh, solve these more questions. Then I will move to the next topic, risk management. Okay, student, before that, I think there was one query of a student. Let me check it. This is Tariq is asking, sir, in the previous class, while calculating EQR using formula, if we consider profit margin and projection for the sale S1 instead of retained earning, the answer would be different whether the reason is keeping the interest cost as a fix. Yes, maybe, but right now I have to take some time. Tariq, I will get back to you. Okay. If possible, you just send me your email ID so that I can contact you over the same. Okay. I will, of course, I will reply the same, but let me have take some time. Okay. Okay, student. Now let us start with the question number 3. This is the question I have adopted from the January 2021 examination. It was in an earlier scheme. So I think after this question, the topic has been included in my classes. So student, please read the question carefully. Then we start solving the same. And many students are saying good morning. Tariq is saying good morning. Guru Ram is saying good morning. Shruti, very good morning, beta. Sadesh Mane, good morning. And Devansh Duryani, good morning. Very good morning, beta. Now, in this question, it says the balance sheet of the Sundry Limited as on 31st March 2020 is as follows. Okay. So the figure has been given to you. This is the total is 14,000, and these are fixed asset amount. Inventory is there. This is current assets. Of course, these are short-term loans. These are payables. So please, student, note that this is purely the current liabilities. It is a major point here. Long-term loans, reserve and surplus, and capital. Sales for the year was 6 lakh. The sales are expected to grow by 20% during the year. The profit margin and dividend payout ratio are expected to be 4% and 50% respectively. The company further desired that during the current year, sales to short-term loan and payable and provision should be in the ratio of 4:3. Ratio of to the fixed loan should be 1.5. Debt equity ratio should not exceed this. Now, student, here I will like to take to you my PPT. Just hold for a second. Just for a second only. When I was discussing with you the external funding requirement, so normally we estimate future requirement that I have discussed with you. Now here it is very important to note that earlier whatever case we have covered, where the sales were increasing by some percentage, but there are no conditions were there. Like this formula is there. However, of course, we are computing this requirement using this formula or analytical, whatever is the measure. But there were no conditions were applied. However, sometimes what happened, In this question, there are some conditions are attached. Okay, there are some conditions are attached. So we have to see how we have to comply with these conditions. Okay, students. Now let us see. Let us go back to the question. Okay, now here it says this is a condition. These are some conditions. Okay, earlier there were no such condition till our first two questions. There were no such conditions were attached. Here we have to comply with. So of course, we are going for external funding requirement, but it is attached with some conditions. So let us see how we can meet the condition. Now, student, please note that when this question has come in the examination, so our approach was simply analytical type. It was not a formula based. Of course, I will discuss with you the formula based approach, but more good answer is I think it is an analytical based approach. So first, I am just solving it based on the analytical approach basis. First of all, it says it's what is we have to require compute the working capital requirement. So sorry, external funding requirement. Okay, let us see. Okay, now let us see how we can solve it. Now, expected sales. First variable that is required to compute is expected sales. I think it is the basis. It is the basis for computing the our EFR requirement. So it is 20% increase. So the amount comes 7,200 lakhs. Okay. Now profit margin is has been given to us. The amount comes 288. Of course, we are paying out 50% as it has been mentioned. So dividend payout at the 50%, it means we are paying out 144. So whatever we left with 144 lakh. Okay. So we are left with the 144 lakh. Okay. That is retained earning law backed. Okay. Now let us see additional funds required. Now our requirement is how much additional funds we required. Student, now I take you to the balance sheet. Okay, I take you to the balance sheet. Now when we see balance sheet, see here our total requirement is total asset is 14 lakh. Let me check is there able to find. Yes, Manjatha empty. Better see, EFR, as I told you in the last class, exactly we are not covering EFR in a study material, but it is a part of financial planning. And since one time question has come, I think it is very important that we should understand the logic because it is a very simple logic. Although it is there is no such a rocket science there, but we should understand the same, and that's why it's essential that we should understand the concept. Now, here, student, you see our total assets are 14,000. Now, however, as I told you, this part is our spontaneous financing. This part is our spontaneous financing. Now, when it is a spontaneous financing, so our requirement of our additional fund will be this minus this, that is 12,000 net asset into point, our increase, that is 0.2. Okay. Okay, student, I hope it is clear to you. If it is not clear to you, please tell me, I will let you know. Now, additional funds required will be 14,000 minus 2,000 because it is a spontaneous source, 0.20. So by this mean, you see, we require this much of funds. We have this much of funds already with us. So balance, that is 2256, will be our external funding requirement. Okay. From, yeah, okay, I'll write it like that. Not exactly external funding requirement, but we can say that we can say it as an external funding requirement also, or balance to be met from external sources. Anything you can write. One second, beta. Shruti is asking, sir, please explain the logic behind it. See, beta, logic is that, as I told you, now see, whenever any business is growing, like in previous question, we have given you three conditions. In a one conditions, on no fixed asset was, there was no increase in the change in the fixed asset, only change in working capital is always by default is there. So there was no change in fixed asset and there was no dividend payout. Okay. In second case, we are saying there are increase in overall asset and there are no dividend was paying out. In the third case, we are assuming that overall increase in the asset, total fixed as well as fixed asset, current assets, and we are also paying some dividend. Here in this case, when nothing has been mentioned, so it is always presumed that total assets will be increased, including your current as well as your fixed. So here our fixed assets is fixed assets are 6 lakh 6,000. Okay, and this is our total assets, that is 8,000. So overall our asset base is 14,000, out of which our a part of is financed by payable and provisions. Please remember, don't include short-term loans as a part of your current liabilities. Of course, it is a current liabilities, but from financing, it is not a spontaneous finance. It is very important to note, student. It is not a spontaneous source of finance. It is because bank does not automatically give you a short-term loan. If your business is increasing, of course, you have to apply to the bank. But for payable and provisions, you not to make any application, etc. So these are called, that's why, spontaneous sources of finance. Okay, student, I hope it is now clear to you. EFR basically will lead to outside liability, right? Yeah, of course, beta, it will lead to addition. Guru Ram Venkat, very good. Yes, additional funds required. Guru Ram, I think, beta. I think you are mistake. Total this photo. Yeah. Okay, 14,000. No, it is. You are saying figure 14 lakh, 14,000, 2,000. Beta, yes. So 12,000 into, but additional fund will not be, see, Gururam, beta, it is not 120%, it is 20% only because 100% is already existing with us. So please get it corrected. Suraj Kumar sir, AFR is basically will lead to outside liability, right? Yes, it will lead to outside liability, of course. Sir, why it is multiplied with 0.20? Manjula is asking, beta, 0.20 we are multiplying because there is an increase by 20%. Please note it. In a short-term loan may be treated as CC limit. Yogesh, even if we treat as a CC limit, but I think there are some. it can be there, we can treat it as a current liability, but for at least we have to say to some bank, because spontaneous sources is a totally different, unless and until something has been mentioned in the question. Tanisha sir, but working capital is 8 lakh, right, sir? So why did we subtract 20 instead of? Beta, you can do one thing. Of course, Tanisha, you are right, beta. Of course, you are right. Observation is right. Here it is a total is 5,000, 3,000, 5,000 plus 3,000, that is 8,000. Total current assets is beta 8,000, and our current liabilities is 2,000. So our working capital is of course uh, 6,000. But since our asset base has been increased, so I am combining this amount only. You can take separately, it hardly matters. Okay, answer will be the same. It is a silent assumption that asset will be minus liability will increase. Yes, it is there. Shruti, it will be assumption will be there. It is a silent assumption. It is by default. Okay, unless and until something has been mentioned. Okay, beta. Now let us see. We have to meet out the conditions. Okay. What are our these conditions? That if company further desires during the current year, sales to short-term loan should be and payable and provision should be in the ratio of 4 is to 3. Ratio of the fixed asset to long-term should be 1.5. Debt equity ratio should not exceed. So these are three conditions have been given to us. Okay. Now let us see how we comply with the same. Now, external means it can be equity, it can be long-term loans, okay, or even short-term loans also. So we are accept the retained earning, whatever funding we are arranging from external. So it is all external. So we have to see that we have to meet from the different sources in what proportion. Sales to short-term loan and payables. So we have to maintain this ratio. So now let us see. We comply with the conditions one by one. First, amount to be raised from short-term loans. Now here, student, our condition says it should be in the ratio of 4 is to 3. Okay, it says our sales to short term loan should be this. So net amount of short term loans and payable and provisions means whatever be our sale, the 3, if our sale is 4, so our provision should be 3. Okay, so now less existing amount of short term loans and payable and provisions. Now see student, here you have to note our, as I told you, our current our payables and provision is 2000. So we shall presume they will increase proportionately. So our payable and provisions will be this much. Please note here I have increased because our payables and provision will be automatically increased proportionately with the increase in the sales, plus 3000 is our current short term loans. So overall this amount becomes 5400. Okay, so amount to be raised from short term loans is nil. Very good. Yogesh, very good, beta. You have got, that is our current liabilities is 2400. So we will not raise any amount because our condition is met. Now I am coming to the condition number 2, that is now here our net fixed asset, yeah, new fixed assets will be, as there is a silent assumption, it will be increased by 20%. True. Now it says our new term, long term loans should be in the ratio of 1 is to 1.5. It means if our sale is 1.5, so our long term loan should be 1. Accordingly, okay, beta. Now let us see less existing amount of long term loans. Now let us see our existing amount is 4000. Okay, so our true. So additional amount. Okay, beta. So here 800 will be raised from the long-term loan. Now I am coming to the third condition. Now it says now because now we are coming to third condition relating to amount of equity. Now student, overall we have to see how much external fund we need to raise. 2256. Sir, why short term in the previous step? Why? Rama Murthy, beta, the we have not increased short-term loan by 20% because 20% our short-term loan is not a spontaneous source of fund. Whereas if nothing has been mentioned, then we assume that our sale will be increase. Okay, our sale will be increase. By the same percent, our sale, sorry, our fixed asset will be increased with the sale in the increase in the sales. Okay, now student please see our external funding requirement is 22,556. So out of this, some part has been already met. How much we have been met from? Some has been met from internal sources. Okay, what has been met from the internal sources? This much we have met from the internal sources. Okay, now this much we have met from the long-term loans. Now let us see how much we shall meet from the equity. Now student, please see in the question it asks amount to be raised from the equity fund. Now this equity funds includes retained earning. Okay, that means we whatever with the retained earning that will be included here. Okay, so when if it has been mentioned, then how much equity to be raised, then we will deduct it. I just show you amount to be raised from equity funds. Okay, the balance will be this. It means 1456. Now, if in the question it has been asked how much additional equity to be issued, then of course it will be 1456 minus 144. This become 1, and I think it will be, so this much of amount additional equity will be issued if it has been asked in the question. Why, Yogesh? Why? But we have increased fixed asset, Yogesh, because it is presumed, that is, it is silent presumption to be 200 will be raised from EQ external. No, no, beta. It is, we will not increase to one. Tanisha, beta is not clear what is you saying. E EO EQ, or I think it is EQ. I not got it. What exactly 200 is figure is there. So student, please note 1456 means our a portion of included here. Here we shall issue the additional equity, means we shall issue the new shares like this. Okay, student. Now let us solve it by the by way of short. We can say by, we can solve it by the formula based approach. This is alternative solution. Now, student, in this regard, I will like to I will like to invite your attention to one very important point. Sometimes in the examination, there may be alternative solution also is possible. So a common doubt among the student is that, sir, do we need to write both solution? Please note, student, please note that only one solution is required, either min or alternative. You need to write down their both solutions. Please note, don't waste your time. Only one solution is there. Okay, so please always remember it. Now I am going by the formula approach. Okay, so I am just putting up the figures. Total assets our 1400. Sales is about 6,000. 200, 2000 divided by this. Okay, our increase in sale is 1200 minus profit margin is 0.4%. Our projected sales is 7,200 and our dividend retained earning is 15. Okay. Ramamurthy and Shruti, beta, I'm just saying, if it is asking in the question that how much funding is required from equity funds, so only, please note, I think you got confused somewhere. I just see if it equity funds includes this 144. Okay, so I am saying if new additional equity has been issued, then this much of equity shall be issued. Of course, a portion will be met out because 14, this 1450 consists two things. One is your retained earning that has been used, that has been 144, and the balance will be new equity will be issued. So new equity will be this. Only I am asking if it has been asked in the question. If in the question it has been asked, what is the equity fund, and we are meeting the requirement of equity fund from the equity, then it will be the only this much unlimited. Okay. If you are getting confused, please leave it here. No problem. So it is same that we have computed earlier by analytical approach. Okay, then second comes funds to be raised from. Now let X be the new short-term loans then meeting the given conditions additional requirement shall be computed as follows. Now here, student, please see, we have to meet the condition of 4 by 3. Okay, if our sale is this is our sales, revised sales upon May. This is our payables and provisions plus new amount of short-term loans. Instead of we try to make, we were doing to have capital reserves 4,000. Shruti is asking, beta, just let me make a complete the question, then I will go for your queries. Just 2 minutes more only. Now, student, please see here. If we now see here, it is our sales, it is our payable and provision, and this is a new amount of short-term loans. Okay. Now we solve the X. The value of X is 3,000. Okay. By simultaneous, just we solve it. So let us see. New short-term loan amount 300 lakh. Okay. Less existing amount of short-term loans. Okay. So additional loan to be raised nil. Same as we have got the answer. Now, Suruji, one second, let me read your query. External regular when instead of if we would like to you like we were doing part one, share capital plus reserve is 50,000 plus ratio 4,200. Mean better, but I think you are increasing. Better, let me check you what are the best solution you have find out, because I am doubtful because we cannot increase the share capital as it is. Okay. See, better provisions we are including as a, of course, it is saying, but in the condition it is including. You are right. In the only in the question we have to ask short-term loans, how much we have to increase. But we are have to meet the conditions, including your payables and provisions. That's why I've included the same. जैसे पार्ट वन में मैंने सॉल्व करा है, पार्ट थ्री में करके। बेटा श्रुति, लेट मी चेक 1.5 का मुझे इक्विटी का डाउट है। आई थिंक देयर आई हैव डाउट रिगार्डिंग 1.5 इक्विटी। गुरुराम वेंकट हर्षित, सर व्हेन वी हैव कैलकुलेटेड AFR that time you have reduced 144, it is again reduced when we have calculated, हाँ, yes I have replied बेटा, 144 has been reduced from the, because if we want to compute exactly what amount of equity, if it has been asked the question, here it has not been asked, only I am saying it is, if additionally it has asked how much new equity have you have to issue, only then you will do it. Please remember. Okay, now second portion, I am coming to the second, long term funds requirement. Now again, let Y be the new long term loan amount, then meeting the required condition, it should be 1.5, means our fixed assets should be okay. Now our fixed assets, earlier it was 6,000, but with the increase it was 1.20. We solve it, we get the answer 4,800. We got the 4,800. So this is the new long term loan amount that is required. Okay, now let us see. Now you see here, beta, we have got the answer of 800, and same answer we have got from our logical approach. That's it. Same answer we have got from applying the logical approach as well as formula. So please, you can follow any approach. Don't worry. Okay. Amount to be raised from Okay. Now let us see whether it is meeting. 1 minute. Shruti is asking करेंगे तो आपको. Okay, Shruti, let me check. Second. Now, this much amount we have to raise from equity. Now, we shall see whether we are meeting the condition that has been given to us or not. Our new debt. Okay. Now, see here, beta. 3,000. Okay. 3,000 our existing. Let me say you. Okay. 3,000 reserve and surplus. Okay. 3,000 reserve and surplus. Okay. Let us see. This is existing. That is new one. We have to see. Okay. Now let us see the answer. Two thousand plus 2,000 plus 1,456. 6,456. Okay, 4,800 divided by 6,456. Amount comes, this ratio comes 74. So our condition says our debt equity ratio should not exceed 1.5 and it is 0.74. So it is meeting the condition. सर श्रुति 5,000 पे 20% इंक्रीज होगा. नो बेटा, इक्विटी पे इंक्रीज नहीं होगा. नो इंक्रीज इन द इक्विटी. वो इस पे नहीं होगा. वो तो आपका जो रिटेन अर्निंग बचेगा उसी से होगा. इट विल ओनली whatever will increase in the retained earning that will be there. Otherwise, there will be no increase. Whatever will left with the retained earning that will be increased only. So I hope, student, and there was one more requirement I think in the question. Okay, student. So I hope now this is a question clear to you. Now I am coming to the next question. Before this question comes, this is basically a strategic type of a decision. Okay, now let us go back to the PPT. Aren't we are going to subtract the retained earning from the amount of it? Tanisha, if it has been asked that you have to calculate additional equity to be raised, only then you will deduct. Okay, if so I just okay, that's why I was not discussing here because students are getting confused. If because ultimately what is happening out of 1456, 144 is our retained earning. So balance 13 1312 is our additional equity to be raised from the market. That new equity will be issued. 1 second. Now, student, this is a kind of a decision. It is also one of the very strategic decision. Bond refunding means uh, sometime what happens, a company may have issued the bonds earlier when the rates of interest were higher. So now, suppose after say 5 to 6 years, the bond duration is say 10 years. Okay, now when at the time of issue. For example, a company may have issued the bonds in the say year 2000, somewhere around 2015. Okay. Now suppose at that time rate of interest was somewhere around 8%. It has issued. Now later on the duration was say 10 years. Okay, these are likely to mature in 2025. Now what happens say in the year 2020 or 19, the rate of interest comes down to say 6%. Now here the company will say why I should pay the 8% when I can get the funds at 6%. So at that time, they take the decision that we shall refund the existing bond and we shall issue for the same amount new bonds. Okay. Because they will say, of course, we shall have a 2% of saving. But there is a provision. This is called call provision. Okay, the company cannot at their choice say, okay, I want to refund your bond and blah blah that. But they have there is a provision that is called call provision. And because of this call provision, because you will understand when we shall in the it is particularly when you will we will shall discuss the topic of option, then of course it will the this option will be clear to you. Call provision, in a call provision what happens, company see there I am just giving you a small hint here. There are two possibilities. Okay, call provision or option. Here please remember, in an option derivative when we said call option means there will different meaning, but here in case of a debenture or bonds, if call option provision has been given, the company can redeem debenture or bonds before its maturity period. Similarly, when here there is another provision, put provision. Okay, in this provision, the investor has the option to get redeemed bonds before maturity. So, but this provision or this is not free of cost. The normally what the company do, the company compensate the investor for such risk, because this poses the risk to the investor that their money can be refunded at any time. Uh, Devansh is asking, sir, we have to add retained earning of the current year. We have current year is already included in the equity funds, because when we are calling about the external fund, we are calling this buyback of the bonds. Yogesh, yes, it is a kind of a buyback of the bond. Actually, buyback normally buyback. I think it is called maturity, because we can say buyback other way around. It is a net off of the current, so additional amount to be 1600. Devansh is saying, sir, net off is additional funds to be raised. No, no, better. 1456 include your 144. 1456 include your 144 because additional amount has been reached from the equity funds, so it includes 144, that the part of profit that has been retained. Okay, students. So here this call provision is basically, so here we have to make a decision, because what happens when a company gives redeem the bond before its maturity and issue the new bonds. So some additional cost has to be incurred, because there is a new flotation cost, okay, and some premium has to be paid. That is called premium. Suppose there is always a clause that if you redeem the debenture before their due date, then you have to pay the premium. Okay, this is called call premium. Okay, call feature is not free of, because companies are supposed to repay the higher amount than the face value of the amount, which is called called premium. Okay, student. Now let us see. So that's why that what exactly is bond refund? Bond refunding decision, we can say very fairly, it is kind of a capital budgeting decision. Since you have already studied capital budgeting topic at your intermediate level, so you will not face any problem. Here, we have to see, because we have to see what will be the saving of the PV of saving in the cash outflows vis-a-vis additional amount, you can say initial amount outlay to make this refund. Because what happens, as I told you, when 8%, we have issued the bond at 8%, now it is we are issuing at a 6% and refunding the same. Now, of course, there will be a continuous saving of the 2% for say 5 years. Okay, because we have to see here the 5 years, 20, but in the 2020, if we are refunding, so this 2% saving will be for the 5 years. So we have to compute how much we can save. So it is a kind of a capital budgeting decision. And student, let for this, let us solve the question, then you will understand the concept very well. Mansha is saying the call option is preferred in a bullish, put option is preferred. But this a concept we shall discuss when we shall cover the topic of option derivative. This is bullish, etc. Not we can discuss here. Now, student, please we go back to the assignment. Now, this is a question. Now, question says like that. DEF Limited has outstanding 10% callable. Now here the callable is there. Bond of rupees 20 crore that has 10 years to maturity. Now 10 years has been left. The call premium is 7% of the par value. So it is the call premium. Since the bond for the last some year, since for the last some year, due to falling rates, the company can issue 10-year bonds with the same feature of the same amount at a 8%. So here our bond has been issued at 8%. Now they want to issue at 8%. So straightforward, there is a saving of 2%. The flotation of the new issue will be rupees 60 lakh. You are advised to calculate, advise the company whether it should refund the old bond and issue at a lower rate or not. So it is a kind of a capital budgeting decision. Now let us solve the question. As usual, if you recall that our similar first part on a capital budgeting decision is our initial outlay. First, we compute the initial outlay. Okay, so our initial outlay requires, here our premium is 7%. Okay, flotation cost, overall it is 2 crore expenditure is there. Clear? Now next part, we compute the annual saving or annual cash flow. Tanisha is saying, sir, with PDF, it is very good summary of the concept. Okay, beta, I will see if possible, then I will certainly share. But my advice to you, student, please to watch the video lecture, prepare your own notes. No problem. If it be possible, then certainly we will share. Now let us see what is the annual savings. Okay. Now see here, our amount is 20 crore. Okay. So of course our payment is basically 10% is 2 crore. Okay. Okay. Saving of interest. Okay. Now let us prepare our. Now our saving is 40 lakh. Now here let us see what is the PV factor. So here the saving is for the 10 years. We add up the factors. Student, please note, whenever we have been given the present value factor table in the examination, please consider this the same. Okay. And because sometimes this question comes in the mind of the student, sir, up to what decimal point we have to take the factors. See student, here in the question, the factor has been given to up to you 3 decimal points. So of course, you will limit your answer to the 3 decimal points. Okay, you will take this value. Now, if in the question it has not been mentioned, then it is up to you. But my advice to you, at least 3 decimal point you can take. Now, in the question, if it has been given 2 decimal points, so you have to follow by the same. Now, when we total it up, the total comes 6.709. This is a total. Okay. So we multiply this factor with same. the same also. Okay, beta, this is our saving. Now, initial outlay. Okay, since NPV is positive, we should accept the, we should refund the, it is not a proposal, we should refund the bonds issued at 10% and issue new bonds at rate of 8%. Okay, student. So I hope this another one strategic decision must be clear to you. Here, in this regard, I will take up this topic when there is a topic of bond valuation, and I will take up this topic. There, I will take up one more question where there are some complications are involved. Because here I have taken a very simple case. I have taken very simple case. Now, it might be possible that sometime what happen, there are some issues like, say, some complication can be something amortization write off. What happens whenever we issue the debentures? Earlier we have issued the debentures and we have incurred some flotation cost. Of course, we are writing it off on the in a forthcoming year. Now there is a challenge when we are issuing the new debenture or bonds. Then how will address this amortization write off? And then there will be a interest period, interest during transition period, means we have to pay interest for during this period, old bonds and new bonds. For these two we have to pay the interest. So all this we shall discuss when I will take the topic of bond valuation. Okay, so I hope with this topic is clear to you. Now I am moving to the next topic, that is risk management. Student, it is one of the very important topic. So let us discuss this topic. Now, first of all, what are the learning outcomes of this topic? Basically, as I told you in the last class, I told you we have to see what are the various types of risk faced by an organization. And please note that these risks are, you can say, it is an illustrative list here. There can be a n number of risks because it changes with the situation also. Okay, now next is evaluation of, because we are more concerned with the financial risk in this, because it is a topic of the AFM, advanced financial management. So we are mainly concerned with the financial risk. Then there is a concept of value at risk. This is one of the very important concept and very interesting. Then evaluation of appropriate method for identification and management of financial risk. Now, student, please note, these three topics are theoretical oriented and this is numerical oriented. So, of course, this theory you can refer from the study material. I will devote a good time for this numerical portion. Okay. So let us start discussing the same topic. Now, this is the first category of the risk is the strategy risk. Okay, strategy risk is a risk which is a company in which the company becomes less effective in struggle to achieve. Sometimes, better student, what happen? A company may have said framed a strategy or have drafted a strategy, or means they have made a strategy that we will do like that. But sometimes this strategy can be not prove fruitful. In this case, what happens? The strategy become ineffective, and ultimately the company start say performing poorly. And sometimes this strategic risk is so crucial that even it decides the fate of the company. The company be can be bankrupt. Like in this concept, I will very famous case. There is a Kodak case. Kodak's case is a very famous this case because with the Kodak was doing on the say film roll using the concept of the film roll. There was a time when there was used to a film roll. We used to click the film, then we have to take out the roll, then we give it to the photo studio. They give us the photos on the paper. But once the digital photo comes, picture concept has come into the light. Although they have started it, they have initiated, they have invented it, but they have not done much research on the same. So ultimately, Kodak has become bankrupt. Okay. On the other hand, no, other companies like Nikon, etc., Canon, etc., they have flourished. So it is very important that what strategic decisions you are taking and how it will impact. So, but because future is uncertain, of course, we have to take some risk. Then next is compliance risk. Now, student, please note that compliance risk is another risk where we have to see that no compliances are left unfulfilled. Because if any compliances are not fulfilled or complied with, then what happens? There is a fine. Okay, there is a provision of fine. Of course, we have to pay the fine. And not only that, even sometimes the reputation of the companies is come also at stake. So compliance risk means we have to comply. Like for Companies Act 2013, there are various requirements. SEBI, once you are not a public limited company, you are a private company. Okay, you have to meet the requirement of ROC. Okay, or just I simply says, suppose there is a proprietor, then proprietor has just not to make any more compilation compliances like only GST and income tax may be there. Okay, once he moves one step further, say he starts exporting the goods, then they may have to meet the requirement of RBI, PAMA. These are all compliances. If they are coming into the partnership, of course, if they are following any LCC, then we have to meet the compliances. Now they are becoming private limited. Private limited, they have to meet the ROC requirement, annual return, etc. And once they enter into the through a public IPO, then they have to meet the SEBI regulations also. So there is a plethora of the requirements. Okay, then a company has to meet. So these has to be meet out with the pace with the trend. Yes, yes, Mansha, you are right, better. Nokia has gone also wrong. Then it becomes a operational risk. Operational risk means day-to-day problems. Okay, it will be related to pupil and the process. Now, pupil and a process means any process can go wrong, and pupil means they can become dishonest or they are not performing their diligently. For the operational risk, there is a one very good example. This is you can say barring banks case. It is a very famous case. In this case, what happened? There is one trader, Nick Leeson, who was on a front desk of a treasury, and he has taken a very huge position in a derivatives. That we will, when we will understand that, discuss the topic derivative, then you will understand. But I'm just for the sake of it, for the just giving you a hint. They have taken a very, he has taken a very huge position, and ultimately, when due to fall in the Nikkei index, the bank has gone bankrupt. The bank has gone bankrupt because of this only one person, Nick Leeson. So this is a kind of a operational risk that, or even there is another category of operational risk that is becoming nowadays very more important. That is cyber risk. Okay, hacking. Like in a recent case of where a hackers has hacked the AIMS server, AIMS Delhi server. That is the case of a operational risk. Okay. Now another case is financial risk. Financial risk are, please, it is important first. Financial risk is referred to unexpected changes in the financial conditions such as prices, okay, exchange rate, credit rating, and interest rate. Okay, generally the prices can be of any commodity. Okay, say for the commodity, okay, exchange rate, foreign exchange rate. Basically, exchange rate means foreign exchange rate. For this, there is a chapter. Okay, this chapter number is I think 10 in your study material. Okay, and then credit rating, the companies can lose its credit rating, and for interest, there is a chapter 12 number. Okay, because interest rate, how the interest rate poses is that, as I told you, if you are in earlier class, if you are holding the investment of say that is giving you the 10% interest. Now tomorrow the rate of interest comes down, increase to 12%. So of course with the same amount you are losing the interest. Okay, so that's the kind of a thing. And even from the company's perspective, like earlier example we have seen, the company can reissue the bonds. So these all risks are faced by investor as well as company as well. Company can face them. If the rate of interest are increasing, then they can also face the risk. But same can be included in, okay, and it is also sometimes included the unexpected political change in any foreign country. Sometimes there is a political risk. Of course, we cover it. It is covered as a financial risk because ultimately it directly impacts our financial position. Yes, Tariq, you are right. HMT watch, Silicon Valley tank collapse, this interest rate risk. Yes, Silicon Valley, yes, Mansha, you are right. Because due to their ALM mismanagement, I think it is a case of ALM. It is a good case of ALM. So next case is a counter. Now, when we talk about financial risk, so let us see what are the categories are covered. First is counterparty risk. It is one of the prominent risks, and this risk is dominant in case of banks. In case of banks, when the borrower does not repay the borrowing amount as well as interest amount, and this case happens in case of a banks where the generally sometime due to circumstances or it may be willfully the borrower defaults. So this is called counterparty risk, and this is one of the prime risk in the category of financial risk. Next is political risk. Generally, these risks are faced by the host action by the political government of the host country. Now, say what happens. Sorry. See, we have discussed. There is one topic in our AFM that is called international financial management, where a company can establish a project in, or they can make some investment outside India. So in that case, they are supposed to political risk. Now, if you have seen recently, whenever there is a political stability, it is a good news for the foreign investor because they start pumping the money because they know that our money is safe. So, but if in a country where the political turmoils are there, so of course they don't know if the government is the same, and generally as a trend, any government comes, they overthrow the whatever the action taken by the previous government, they overrule them or they disregard them. Or so in this case, what happens? It has been observed that whenever any company has make some investment, so it may be possible that the government may become hostile. There were many good case. I remember the GMR has make some investment in, I think not recall, Maldives or some country maybe there. So they have made some investment in any country. Well, airport. They were making their airport, and ultimately what happened? The government on a one day said, "Ki please go out." So for GMR it was a big shock. For GMR it was a big shock because they incurred a very huge losses. So it can be happen anywhere. Okay, so this is called political risk. Now we shall discuss a little bit in more detail later on. Now next is interest rate risk. This rate occurs due to change in the interest resulting in asset and liabilities. Now, how it result in change in assets and liabilities. This is more important for the banking company because it is more as their balance sheet items are more interest sensitive and their base earning is spread between borrowing and lending. I show you how it works. Now see beta, what happens? This is what is this spread means difference between borrowing and lending. Now suppose bank is borrowing at say 6%, but they are lending the money at 10%. Okay. Now what happens? This spread of 4% is basically bank's earning. Now suppose tomorrow the rate of see generally these borrowing and lendings are for the long terms. Okay, of course there is short term provision also. Now suppose I just give you a very small example. Suppose an investor come to bank and he deposits say rupees 5 crore with a bank at the rate of 6%, say for 5 years. Okay. Suppose on the same day, and a borrower comes to the bank and asks for the bank for the 5 crore at the rate of say, now here the bank borrower will be negotiate. After borrowing, say the bank has reached to a conclusion that, okay, let us see 8%. So bank has given him the loan for the 5 years at the same. Now there is a difference of 2%. Okay, now what happens? Suppose after a period of 1 year, suppose benchmark rate, the FD rate increase from 6 to say 8%. So what happens? This investor may come back. Okay, he will say, I want to get maturity my amount of 5 crore because I want to now invest at 8%. So in that, but what will happen? Who has bank, the borrower may not come back to refund the money. Okay, because he knows that in the market rate of interest are going up. Of course, I will not get the rate of loan at the same rate. So because if he goes to the market, he finds that I have to pay 10% for the same loan. He may not come back, but this has come back and bank has to refund the money. In that case, what will happen? It will be a problem for the bank. Okay, it will be problem for the bank. How it will be problem? First of all, there will be a liquidity risk. There will be a liquidity risk that we will discuss next part. And there will another issue is that in the balance sheet, there will be a valuation issue. Okay, I'm not going into the valuation part, but this kind of a problem is there. So, and suppose if the bank has given, and even suppose I give you another example. If the bank has invested the money in some bonds, then it will be also a problem. So all these problems can, because it is bank's balance sheet is more interest sensitive. Non-relation from the one second students. Ukraine versus Russia crisis is geographical crisis. Yes, you are right, Yogesh, non-relation of data. It is also a kind of a liquidity counterparty risk because once we have given the money, they are not performing assets. Very good, Suraj. Sir, every type of risk may impact other companies, so we financial is sensitive to. Tanisha, of course, every risk impacts the finance of a company. Ultimately, impact will come on the finance. But sometimes financial risk is generally that kind of a risk that is visible directly from the balance sheet or from the profit. Because interest rate risk, liquidity risk, and counterparty risk, these are risks, and normally these are risks more crucial for the banks. For a simple organization, for a manufacturing organization, financial risk generally comes into the category of foreign exchange because once the rate moves quite heavily, then only they face the risk, financial risk. Otherwise, there are other risks they are attached with them. For a financial risk is mainly more important in banks because their all the items are financial items, directly financial items. Then there is a currency risk. Now, how the currency risk? It is a topic that we shall discuss. Now, suppose I just give you a very small example. Now, suppose today's dollar rate is say 84. Okay, you export goods of 1 lakh dollar. So you are expecting that I will receive 84 lakh because normally whenever we export the goods, the payment takes around 2 or 3 months. By the time we receive the money, the dollar become weaker and Indian rupee becomes stronger. That nitty-gritties we shall discuss later on because what is exchange rate, etc. So in this case, you will receive the amount of 82 lakhs. So you were expecting 84. Now this loss is a loss to you. This is case of exporter. Okay. Now similarly we can say importer. So suppose you have imported the oil for that or anything goods for the $1 million. Okay, today's rate is say rupees 83 per dollar. So you were supposed to make the payment of 8 crore 30 lakh. Now by the time you have to make the payment, say it has raised up to 85. Rupee has become weaker, dollar has become stronger. Then straightforward 20 lakh rupee lost to you just within a span of. So this is called currency risk. Okay. Of course, there is a chapter for the same, so we shall discuss it. And then last is your liquidity risk. Liquidity risk can be defined as an inability of an organization to meet its liability when they become due. That I have discussed with you when I was talking about this case of bank. So whenever sometime what happens, and this may be due to some poor cash management. Main reason is that poor cash management may be there, and it can be happen with any individual one also. Sometimes we may have a more money, sometimes we have no money. Even we have to spend maybe our business. So student, here I am taking a small break. I will come back after 10 to 12 minutes. So meanwhile, whatever we have discussed, you can go through the same. So let us go for a break. Ashok ji. Come back, students. Let me check whether I have received any query. One second, students. Let me check, student, whether we have received any query. Yes, sir, every type of I have discussed it, not NPA. Then, okay, Manoj Kumar Pandey, your email is there. I will certainly reply to the same. Strategic financial management, internal, micro, as well as, oh, yes, Mansha, you are right. He has to take care of both. Okay, student, let us now see what is liquidity risk we have discussed. Now, quickly, I am covering, one second. Now, evaluation of the financial risk. Now, from stakeholders' point of view, now if I talk about how the financial risk evaluated by different persons. First of all, from the stakeholders' point of view, it basically uh, generally from the shareholders' point of view, it is basically concerned with the gearing ratio. Okay, ratio of debt in the capital structure. Because if you recall that there are in the intermediate you have studied the topic of financial leverage. Okay, operating leverage. So generally these are relating to the same. From the financial leverage, we know how much the fixed interest, fixed cost, financial cost is burden is there in the capital structure of the company. Because when the company will be winding up, of course they will get the priority. Then there is from company's point of view. Now, from company's point of view, the risk is when they uh, borrow the money in excess of their capacity. So then they can go into the bankrupt, or even sometimes they for the bank they lend the money to some borrower which goes bankrupt. Okay, then bank can be failed. Then there comes the government point of view. From the government point of view, especially like case of a Lehman Brothers, it was a unique example because whenever any bank fails, it is a dent to the economic system. So it hampers the system, and that's why from government point of view, it is very important they keep on watch on the banks. Like student, if you have you have any knowledge about this Basel guidelines, Basel 1, Basel 2, Basel 3, all these are guidelines are there where there are some criteria that a bank has to maintain their liabilities or risk. Even the topic that we shall study where it is also somewhere covered in the Basel guidelines. In a Basel, these are guidelines provided by the Basel. There is a kind of accord at Brussels where I think the Basel is a place where the accord has been entered into where some guidelines are there. A bank has to maintain this much of assets, this much of liabilities, this much of cash. So all guidelines has to be met because they ensure that the solvency of the bank. Then next we comes to the value at risk. Now, student, this is that numerical based topic in your risk management chapter. Now, value at risk. I just read out this statement. How much can we lose on our trading portfolio by tomorrow's close? Okay, now this statement has been given by one time JP Dennis Weatherstone. Dennis Weatherstone. Once upon a time, the chairman of JP Morgan. Actually, this concept value at risk has been invented earlier somewhere in it was earlier concept some 1923 something but it has gained popularity in 1990s when JP Morgan has started using the same. Now it is a kind of a it is a you can say it is a system measure it is a measure of the market risk. It is not a technique of risk management, but it is a measure of market risk. By this, where we came to know how much risky is our portfolio. Portfolio means whatever stocks we are holding, whatever the position we are holding. So by this, we came to know what is our position. What is our position? So it is one of the very important concept and that is normally frequently used, especially in case of a bank. And it has its importance has been increased in 1993 when G20, G30, Group 30 has endorsed as a best practice to deal with derivatives. When we talk about the derivatives, when we shall discuss the topic when the topic will come. However, uh, this derivatives basically implies you. It helps you to hedging your position, or you can use it for speculation. That is that we will discuss later on. But however, this where is used especially for the derivatives positions. So that we will discuss later on when you will understand that what is derivative, then you will came to know. But however, where is used when the used very popularly because as it has been endorsed by G30. Even Basel norms also advocate the same. Now let us see what exactly where is. Banking regulations. Yes, you are right. Banking regulation, tolerance level. Yogesh, tolerance level. You can say that it is a kind of a tolerance level, but it can say yes. You can. It is not a tolerance. It is a kind of a confidence level that I will explain when I will take the definition. This definition further. Now, what is value at risk? As per Wikipedia, where is a measure of a risk of investment? First of all, given the normal market condition in a set of periods, say one day, it estimates how much an investment might lose. This investment can be a portfolio, capital investment, foreign exchange, etc. So basically, when where answer two questions: what is worst scenario and what will be the loss? Okay, what will be the loss? Because it gives you the level of confidence that say how much you are going to lose, how much. For example, I just now let us see what are the components. First of all, you see the component, and I will explain you by the example. Where calculation based on three components. Say time period. It can be one day. It can be generally week. It can be 15 days, fortnight. It can be month, or it can be weeks, or it can be semi-annual, and it can be annual. So basically, there is always a time linked to the where. How much I am going to lose in a 1 month, 1 day? How much I am going to lose maximum loss? How much I am going to lose in 1 day, 1 week, 1 month, say one fortnight, like that. Similarly, confidence level. This tolerance level or confidence level means how much confidence I am, how much confident I am that I am losing, not go, see, I'm not going to lose more than 1%. 99% means not more than 95 means not more than 5%. So this let me know, and exactly this is also let me know the what is the loss in percentage of the amount. See student, I tell you the basis of the where. Where is basically let us know about how much I am going to lose. But I am say I want to confident that how much I am 99% confident I am not going to lose this much of amount during the span of one day, one month, whatever be the time period. So this is a level of confidence that comes that we measure from the where. Okay. Accordingly, the if we see it other way around, there is a 1% probability, there is a 1% probability, or there is a 5% probability our my amount of loss shall not exceed a certain amount. That is called where. Where means my where is, say if I say my where is say 5 lakh, the portfolio of my where of my portfolio is say 5 lakh at 99% confidence level. So it means it implies that there are 99%, there are 1% probability that there is 1% probability that my loss will exceed 5 lakh. Okay, there is a 1% probability that my loss will be exceed 5 lakh. Okay, say it will be one day. Okay, it may be 1 week. So say if I say just I give a statement, then it will be more clear to you. I say okay, now at 99% confidence level. So what does this imply? It implied there is a 1% probability that loss in the value of my portfolio will be will exceed rupees 5 lakh in one day. Okay. Now suppose if I want to change it to the say week. Okay. Say I want to change it for the say uh, year or month. Then I have to use one formula. Just I give you the formula. Okay. Now I say my where is what in a 99% confidence level where is 5 lakh. If I want to say I want to know the where of a 1 week. Okay. And in a 1 week there are 5 trading days. Then what I do, I multiply like that. Okay. Now I got the answer. Let us see what is our answer. Okay. Now this statement will implies my the where of my portfolio at 99% confidence level for a week is rupees 11,18,034. Okay, saying it otherwise, 1%, there is a 1%, there is a 1% probability that loss in the, one second, loss in the value of my portfolio shall not exceed in a 1 week. Okay, student? WAC minimize the effect of rising from the speculation market. Manisha, the WAR can minimize, not, it is a, not a risk management technique. Please, not that. It is only a measurement technique. Now, it has to be as per your risk appetite. Okay, this is a quite vast topic. How we deal with the hedge, where to take the position, that is beyond the scope of this level. Only we have to just understand what is the basic WAR. Okay, student. So I hope now let us see, try to attempt one this MCQ. Okay, student, please they see this MCQ. Then I will give more discussion. First, I'm just simple using the same discussing with you the time aspect. Then I will proceed for further for the questions. Now here it says, suppose the WAR on the portfolio using a 1 day time horizon is 100 crore. The WAR of the same portfolio using the 10-day horizon shall be. Now, I am waiting for your answers. Which option is correct? Very good, Tanisha. Your answer is correct. Yogesh, your answer is correct. Suraj, please check better your answer. As I have used the formula, please apply the formula again. Yogesh, your answer is correct, beta. And Yadu Kundulu Chitla, your answer is correct, beta. Very good. Devansh, your answer correct. Mansha, your answer is correct. Manoj, your answer is correct. Very good. Students and Muhammad Abdul, very good, beta. You are also doing well. Okay, student. Very well. Other students are answering well. There are many students are sending the, because it is quite become difficult for taking the names of each and every student. Tariq, very good. Very good, Tariq. Yeah, Tariq, I have got your name. Okay, student. Now let us see the formula. See, here the time horizon is 1 day. Now we have to convert it on the 10 days. So see, whatever be the basis, first of all, we write the basis 100 crore. Now this basis for the 1 day. So accordingly, if we have to change it, we do like that. Okay, simply rupees 100 crore. So our option C will be, is a correct option. Yogesh serving 100 appetite of the portfolio. The portfolio will be this is war value. Mm, yes, you are right. Yogesh, to some extent you are right because we are taking opposite to the same. But anyhow, I cannot show very well because we have to make some computation. Let us see. Of course, this is a comput. There is one numerical on the same line. Then we shall discuss the same. Okay. Okay, student. Now I'm coming to the next MCQ. Here I will try your patience and please don't do it quickly. Apply your mind here because it is a some googly is there. Sir, yeah, square root of 10, beta. Yes. Suraj, yes. Sumit is asking, sir, where is used for both loss as well as profit? See, beta, it is not used for profit or loss. It is basically a kind of a risk measurement, as I am telling you. Now, as I told you, it is up to you whether you want to, what is your risk appetite and how you deal with the same. Because sometimes it indicates the risk level of the companies also, especially in case of a banks. At what VAR level they are operating. And I recall that very good question has been asked, and I recall there is a movie. The name of movie, I think it is the Margin Call. It is a Hollywood movie. I It is a good movie. I recall it. Margin Call. There is a movie. This is based on VAR concept. Okay, where there is in some asset, their company is holding some portfolio, and one of their employees came to know that the VAR at which the same portfolio is very high because they are running a very huge risk. So it was a good movie. It is a good movie. You can get it on I think Netflix or somewhere OTT. But it is a Margin Call. It's a good movie. It is based on the concept of VAR. Okay, is saying option A is the option. Tanisha, you are right, beta. Devansh, you are right. Mohammed Rahim, you are right, beta. Mohammed Abdul Rahim, you are right. Very good. Yadu Kundala, very good, beta. Tariq, you are right. Somewhere, yes, you are right. Tariq, it is nearby approximately. Yogesh, you are right. Now, student, here there is a googly. What is googly? In earlier, our base was 1 day and we want to extend it. However, here our base value is annual. We have to compute for the daily. So daily means 1 day and there are 250 days in a year. So accordingly, what we do, how we compute it. Okay, somewhere it will be near to the same. It is hardly matters. The value will be can be differ small. Okay. Okay, students. Now I am moving to the next question. Next MCQ. What is the answer? Tanisha. Yes, Tanisha, your answer is right. Devansh, your answer is right, beta. Mansha, your answer is right. Very good. Manoj, no, beta. Please check your answer. Manoj, please check your answer again. I think you have missed. Manjunath, beta, you also check again your answer. I think there is slight mistake. You are just near to the answer, just slight mistake. You have to see here, beta. It is a 50 weeks. Okay, not 250 days. Shruti, your answer is correct, beta. Binny, Binsi, my Binsi CA. Yes, your answer is correct, beta. Yogesh, yes, your answer is correct, beta. Now here, our base is annual. Okay, there are 50 weeks. Mohammed, your answer, beta. Kundulu, yes, your answer right, beta. Okay, students. Now quickly, I am moving to the next question so that I can wind up this part. Then I will move to another question. I have to calculate the semi-annual this time. Suraj, your answer is now your answer is correct. Yes, very good, Suraj. Manjunath, MT, your answer is correct, beta. Tanisha, your answer is correct, beta. Mansha, I will reply to this query later on. Please hold for some time. Please be in the pace with the class. Okay, I cannot answer your query that we are just going to discuss. Devansh, your answer is correct, beta. Okay, students. Here I have to see basis on the neither it is a days nor it is a weeks. Now I have to calculate semi-annual. This base is basically for a 1 month, 1 year. For semi-annual, I have to consider it on a you can say 2 days, basis. Okay. So what I will do, so the option is C. Very good. Yogesh, your answer is correct, beta. Muhammad, yes, your answer is correct. Very good. So, student, I we see how we can adjust according to the time. Now, I am just discussing quickly the feature. Then I will touch upon the this numerical part. It is a statistical method, first of all, and base is a standard deviation. It is very important, student. unless and until we got the standard deviation, because from the standard deviation we know how much it is going to vary. Yeah, showcase approximately it is like value is like. So it is a very important that it is the basis is the standard deviation which is indicated by this sigma. Next statistical feature, time horizon. When we apply to time horizon that I have discussed with you, I not comment upon the same right now. Then probability. It is very important. The values are normally attributed or probability of the maximum loss can be predicted. It is very important. Normal word is very because here we shall use the normal curve. It is generally considered as that the values are normally distributed where the mean value is in between. 0.5 here area, 0.5 here this area. Okay, 125 days. Shruti, beta, well, then we have to convert it first. Either you can do one thing. You are right. We can do one thing. First, we convert it into the daily basis. Then we multiply with the 125 days. Then you will get the answer. Square root of 125. Please check. If you don't get the same answer, then let me know. Okay, student. Then next comes the risk control. What are the features? It can be controlled by setting the limits for a maximum loss. Now here we shall see in the questions that we set a limit. We cannot go beyond this limit. So we know we can come to know about their probability and what will be the probable loss. So all this we can use. We can use in that way. Jet score. Jet score is a very important. Standard deviation is away from the mean value of the population, and this is called standard normal variable. That is called standard normal variable. And when it is multiplied with the standard deviation, it provides a where. Where is basically we can say Z score into standard deviation. Okay, Z where is equal to Z into this is the standard normal variant. Okay, and we multiply the this. So this variable we can came to know from the this is we compute the value. We came to know the variable. Then from this Z variable we can also compute the probability. Okay, then the level of confidence. All these are interconnected. When we shall solve the question, then you will come to know. Okay, now application of where maximum low trading days position benchmark for the performance management of any operation. It is used mainly in treasury to fix the limit of dealing in the front desk and the treasury department, because in a front desk you cannot take that beyond position or you cannot take that much of level risk. To enable to management to decide the trading strategies as a tool of asset liability management, especially in case of a bank, because they have to see where of both sides, balance sheet as well as asset side as well as liability side. Manjul Lathanath, sir, practically how can we use? See, better there are n number of uses. I cannot describe all the uses here, but once you will go into the practical life, you will automatically see there are many uses of the same. Sir, how we get the jet score? Yes, I am giving you the formula. Okay, I am giving you the formula. Yes, I think your answer is to somewhere. No, 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 no. I think somewhere, Mansha, you are mistaking somewhere. Please check again your answer. Shruti, if the school 0.8 say no, no, no. I just check it out. Just give me 5 to 10 minutes, then I will come to you. Okay, madam. Now here, one student is asking, sir, what is the formula for the jet? Yes, I am saying, when I will give you discuss the question, then you will come to know what is the formula. Okay, just have some patience. Okay. Now let us see the assignment. Then I discuss the question. Now, first of all, let us go back to the assignment. Then I start discussing the question. Student, please read the question. Then, meanwhile, I just standard deviation 125. No, 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 no. You mean to say annual? It is 765. 125 days. No, 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 no. 250 times there. It is coming. 1760. I think somewhere near about we can say it's your value is something because days 125. Of course, Mansha and Tanisha, I will work upon this because you are saying 125. If you take in denominator, then certainly it is not going to work. Well, let me check. It's other way around. If I check it other way around, let me check better. No matter it will not be 125 days because here if we take the 125 days, then the formula that has been suggested has we have been given the figure of semi-annual basis. Okay, no, we cannot use this formula. Your formula is approach is not correct. Okay, now students, question says like that: need horse uh, rupee 10 crore shares of XYZ whose market standard deviation is 2% per day. Assuming 252 trading days a year, determine the maximum loss over a given period of one trading day, 10 trading day with a 99% confidence. Assuming that the share price are normally for level of 99%, the equivalent jet score from the normal table cumulative area shall be is 2.33. Now, student, please note that in the end of the assignment, I have provided you the table. Now, although this table variant has been given to you, see 99% means I just show you how we do it. You see the concept of this is concept of normal curve here. Okay, student. Now see here, this is 99% means basically what we do. I just tell you by way of diagram. It will be more. One second. One second. This is area under normal curve. Okay. Now, if I say it is a mean, it is a mean value, and if we say basically we what we do, we take the cumulative area because this you have studied at your 12th class level normal for finding the probability. So here, if I say that this area covers the 99%, okay, if I say this area is 99%, okay, the jet factor will be here 2.33. Okay, the jet factor will be 2.33, and this can also be located from the table as well. Let us see the table. Now, please see, student. Here, please see 2.3, and somewhere here this value is there. So it is approximately the 99%. It is a 99%. Okay. So this variable is basically the Z score has been given to me. If we have been given in the table in the examination, then table will be given to you. Of course, the value Z score, this value will be given to you in the question itself. Okay. If nothing has been given, then certainly table will be there. So here the Z score is basically we have calculated this is a 2.33. So we have to calculate how much is our loss. Okay, volatility in terms of loss. So let us calculate the volatility. Now it says 2% per day. Okay, and our confidence here the value is 10 crore. Okay, so first of all we calculate the it says we calculate the volatility, then we shall calculate the VAR. Our portfolio is basically of 10 crore. Okay, our standard deviation is 2%. So our standard deviation in terms of rupees is rupees 20 lakh. Okay, the maximum level of loss with 99% confidence shall not exceed. ठीक है ना? How much the maximum loss, or we can say maximum loss, we can say just like that. So rupees 20 lakh into 2.3. So it is a kind of a VAR, the VAR of the portfolio, the VAR of the portfolio with the 99% confidence is this. Yogesh in 13. Beta, Yogesh and all are doing one mistake. See, beta, our basis is annual. So from annual, we have to convert it on the basis of the period or the extended period. If I take 120 days, basically 125 is there are 125 not are semi-annuals in a 1 year. Okay, please note it. Okay, so here the 46 lakh, 0.60 lakh, they say the expected maximum loss for the 10 trading days. Here our value we have computed this is for the 1 day because our standard deviation is was for the 1 day. Okay, so our VAR or we can say lakh will be rupees 10 into 46 point this. Okay, so our answer is 147.36 lakh. Or we can calculate it other way around also. Student, standard deviation of portfolio for 10 days. We simply multiply 20 lakh into square root of 10. It comes better 63.25. Okay, it becomes 63.2 lakh. And when we multiply 63.2 this lakh with 2.33, that is Z score. It becomes 147.36 approximately. That way we can also calculate the same. योगेश डेली बेसिस पे नहीं आएगा बेटा वो you try to understand there here we have to see how many period in a basis day here in an annual there are only two semi-annual so that's why we have considered we cannot consider 120 150 of course you are saying one because it will consider as a 150 days only but 250 days for the 1 day basis only for semi-annual it cannot consider 250 because basis is different. Okay, student. Now I am moving to the next question. Then I will show you how we compute the Z score. That is called standard normal variance. Please read the question carefully. In this question says ABC is considering the project X, okay, which is normally distributed, has a mean of 2 crore with a standard deviation of 1.6 crores. In case ABC loses uh, on any project more than 1 crore, then there will be a financial difficulties. Determine the probability the company will be in financial difficulty. Now see here, student, but we have to calculate first of all. We can it is a kind of a question of a where that how much now here we shall compute the probability. So it is a kind of a reverse application of the where. Our mean has been given to us rupees 2 crore. Okay, standard deviation has been given to us that is 1.6 crore. So we have to compute how much loss, what is the probability that there will be a financial difficulty. So if I draw the normal curve, bell-shaped curve, so somewhere the value will be here. So I have to calculate this probability. Sorry, not probability. This is the probability. See here, my if I move here, so I will be in the financial difficulty. Okay. So what I will do, I will calculate the probability up to this point, and then I will detect it from the 1. Okay, for this I need the calculate the Z score. I need to calculate the Z score for this point. How much is the Z score? Accordingly, I will get the value. Okay. Now here I will use also the formula of interpolation. What I understood is if we invested 5 crore in that day, we just take your query, Manjunath. Please just hold. Here, 5, we have taken here Z. Now we have to compute the Z score. Okay. Now let us see how we compute the Z score. Standard normal variance. This is X. X means this value minus mean upon standard deviation. Accordingly, I want to know what will be the my financial difficulty, and this accordingly 0.60. Okay. Now we can say it like that. Even we can use without disregard the value, no problem, because this value is for a calculate seeing the value, this negative sign we can ignore. Okay, it hardly matters because we have to see this value. Now we go to the table. Okay, now let us locate the value. Now student, here please note that we need the value 1.875. Okay, now please see, this value will be lying in between. Okay, so now we shall use the interpolation. Okay, we have to compute for this, then we shall use the interpolation. Now how we use the interpolation? Please note that it is a cumulative area. The difference here is like that. The corresponding, see, we how much we require? Now this is value basically we have derived from 1.875 minus 1.870. Sorry, my mistake. Okay. Now corresponding figure, let us see. Okay. Now let us add this figure in this first value. Okay. Now here the probability is this whole area probability is 96.96%. Okay. Accordingly, the probability that there will be a financial problem, there will be a financial difficulty, one minus 0.9696. That is 0.0034. Okay. That is 3 point, 1 second, 1 minus 0.96. Yes, 0.03. Just a second. Okay, so it is basically 0.034%. Okay, student. So I hope with this the concept of where must be clear to you. Meanwhile, I take up the query of Manjulatha. Manjunatha, where I understood and invested by choosing a market, we estimate maximum and just for then yearly to 10 days. Is this correct? Yes. See, it depends on, I tell you, your point is say like that. If you're investing some amount, so of course you have to calculate the standard deviation. First is the basis of standard deviation. Now this standard deviation can be basically on a historical data. Because all the from the basis of historical data we derive the standard deviation of any portfolio. From that portfolio, if the say standard deviation is 1 day basis, then you have to get it converted according to your own requirement. How long you are continuing with the portfolio, and it is very important that there should be no change in the portfolio. You should continue with the same portfolio. There is no change. So if it can be 1 day, week, or month. So suppose if you have calculated for the standard deviation for the 1 week, then of course the basis is the 5 days. Then accordingly you can see or you can measure how much confidence level or what is the confidence level that my loss is not be more than it. So you can say you are on the same line, but you are saying in a different manner. SD or beta is beta. I won't here discuss the same. Sorry, beta Yogesh, I cannot because if I discuss this term right now, then it will be open end class. I will discuss whenever we will just take up the port, but it is not the same. It is not the same. I think you must have been watching some other videos, but it is not the same. Right now, I cannot. Okay, student. Now let us come to the question number 3, and this is the last question of your today's assignment. This question has been adopted from your November 2020 old scheme examination. Just read the question. Now it says, on Tuesday morning before opening of the capital market, an investor while going through his bank statement has observed that an amount of rupees 7 lakh is lying in his bank account. This amount is available for the use from Tuesday to Friday. So it means for how many days it is? Tuesday, Wednesday, Thursday, and Friday. So overall 4 days are there to utilize this amount. The bank requires a minimum balance of rupees 1000 all times. The investor desires to make a maximum possible investment where value at risk should not exceed the balance lying in his bank account. So this is the VAR limit. Maximum loss. Okay, maximum loss he can afford. The standard deviation of the market of the security is a 1.5% per day. That is 1.5 per day. Now here is a 1 day concept. The required confidence level is 99%. Okay, so let us see the answer. Well, I should do move on this. Okay, students, now let us see the solution. Now, here, since we are using the concept of where, so it is a kind of a maximum loss. It is a kind of a maximum loss for the 4 days at 99% confidence level. True. Now, now we convert it into the 1 day. Okay, by okay corresponding Z score. Okay, now it says we have to it says we have to level of 99% confidence. So according to student, please see where in this table we shall locate where exactly the value of 99 is cumulative area. Here the value is coming 99. Okay, so the correspondingly the Z score here 2.33. Okay, Pooja Kumari. No, madam, not. I think November 23. I don't think it. I don't recall it. Don't think it is from November 23. No, no. No, it was not from November 23. No, it was not from November 23. Okay, students. So let us see. So we have seen from the table that Z score from corresponding is 2.33. Okay. Now we compute volatility in terms of rupees. That is standard deviation. Okay. In terms of rupees at 99% confidence. So we divide this 3,49,500. Okay. So this is a standard deviation at a 99% level. Okay. So maximum possible investment. can be made is volatility in rupees divided by standard deviation. Standard deviation has been given to us as 1.1 lakh 5,000 and standard deviation is 1.5%. Okay, so the value comes. Okay, the investment comes 1 crore rupees. Uh, okay, you want to say, sorry, Pooja. Pooja, beta, there will be a session. Whenever I will take my, see, you start doing, don't worry for the November 2020 23 examination. I will, you can contact me over the telephone or you can send me a mobile app through the mobile app. We will let you know how to restart because you can easily start, no problem. Okay. Now, students, see here the maximum investment, or you can say maximum possible investment is 1 crore. Here, a student one time asked me, sir, when if a doubt maybe raise in your minds, sir, when I have only 6,99,000 rupees in my account, then how can I make the investment of this? See, student, this investment can be made even by borrowing the money. Okay, because whatever the money has been left with you, considering the standard deviation, even if you lose out your complete money, you can make this much of investment. If your investment goes up, then of course, then you are betting on the investment, and then of course you are gain big. But max 99% chances are that the maximum loss will be of 6,99,000 in a 1 day, in a 4 days span of time, or you can say yeah, on a 1 day basis. You have to consider it on a daily basis. Daily basis you have to consider or maximum, because you have to short your cover your position. So maximum you can make the investment of 1 crore. So even this can be on the basis of a loan, because this doubt raised in the mind of students, sir, when I have only 6,99. Of course, you have 6,99, but these are meant for your cover up your losses. Your investment is nothing to liquidate, and you can take the loan from the same. Okay, student. With this, we come to the end to the assignment. Now I am just quickly covering up the leftover portion of our session. And then of another 5 to 10 minutes, I will wind up the session so that our two topics are covered. Okay, students, now I am coming to the identification and management of financial risk. All this has been covered in your study material. You can refer from there. Yes, I will share my contact number better. Don't worry. Okay, you can contact me on the Monday, because today is holiday. Uh, this is identification of the counterparty failure to obtain necessary resources to complete the project and transaction undertaken. Normally, what happens? suppose you have given the loan uh, to any person for any project. Now, even if he has not complete the process, he is not making any efforts to making you can say starting the project. Then it is a hint that your money is going to be is not money is going to become a bad debt. Because like in case of what happens, it somewhere it has happened around in 1990s, very much there, when the companies have floated the IPOs and they have run overnight. Okay, promoters have run overnight to somewhere country because they have gone with the money of the investors. But after that, only the SEBI has come into the picture for the protection of the investor. Any regulatory restriction from the government, say if you have given the money to your friend for some particular project and this project has been declared illegal by the government, then of course your money is going to be bad debt. Hostile action of the foreign government. You have invested somewhere else, the government has become hostile. Led on by the third party. Third party says, I'm not paying to you. Just they say plainly no. Has become insolvent. Beyond their control. They has become insolvent. Then comes the counterparty risk, how to manage it. Carry out due diligence. Okay, before dealing with the third party. Do not commit to a single party or group. It is a connected entity. It is very important because it is also called concentration risk. Okay, you have like it is a kind of a diversification. In case of a diversification, you diversify your investment. Similarly, don't give the money to any one person or give the goods all on the credit to any one person. Know your exposure limit. These limits are defined like where. Here the where are used. Okay, this much of limit. Review the limits and procedure for the creditor approval policies. React upon the likelihood of default. If there is chances are default are there, then react immediately. Waiting before, because once you have any hint, just start getting back your money. Try to get your money. Use performance guarantee, insurance, and other instrument like credit default swap that will be covered in credit derivatives. Okay, so there we will understand. Okay, insure performance guarantee means you take the guarantee from other person. Insurance. Okay, these are the instruments that can be used. Next comes the political risks. Identification and management of financial risks under this actions. What are the actions of the host government? These are the indicators. Insistence on the resident investor or labor. They say you employ the resident labor. One second, entry master. I could not get entry master, entry operator. Maybe yes, so I cannot get what exactly you mean to say, Yogesh. Expropriation. Expropriation means it is the kind of a seizure of the foreign assets, seizure of the company's asset by the foreign government. Okay, say they say whatever you have invested there, you are not allowed to sell it here and just go back. Just whatever your investment, it is gone, it is acquired by the government without acquiring by the government without any compensation. It is called, we can say, acquiring by the government without or educate. Okay, pay fixation of a product. They tell say you have to, you cannot charge beyond that amounts. Now, how you assess the risk? These are the refer political ranking. These are published by some business journal. They give the political ranking. Evaluating countries' macroeconomic conditions, analyzing the popularity of the current government and assess their stability. It is very important. You should assess what is the popularity of the current government. Like recently, I think in Bangladesh, their prime minister has been likely to be re-elected. So it is a very important criteria. By taking the advices from the embassies of the home and is a very important. We can approach to the embassy also. Then it comes the techniques to mitigate sourcing local raw material and labor. It is very important. Once we employ the labor of any country, so if the government says ki, okay, you move out, you say ki, okay, I move out, your labor will be unemployed. So they may say ki, okay, okay, stay there, no problem. entering into the joint venture with the local investor, because local investor have a vested interest with the project. They won't say ki, okay, don't move, stay here. So it is a local financing, use local sources. Say if you have borrowed, say if you are establishing any project in any African country, and if you get invested Indians money from here, then of course if the expropriation risk is by the in the project by the government, then certainly Indian investor will be stand to lose. If African investor is there, then you need not to worry. You can say to your African investor, I am helpless. My your government is not cooperating with me. Then prior negotiation, it is very well. Uh, it is very well accepted that uh, it is very well accepted that uh, uh, sometime what happens, you negotiate with the government. Okay, you negotiate with the government that I am going to establish this project, and it is very commonly happen. At least for the 10 years, whatever government next government comes, you cannot take any action against me, like this kind of a prior negotiation. And Jogesh, I think you have taken the correct name of the Bangladesh prime, supposed to be prime minister. Now, identification and management of financial interest rate risk. This is monetary policy of the government, action taken by such a demonetization. During the demonetization time, the rate of interest were uh, falling down. Economic growth, release of industrial data, investment by the foreign investors, and stock market change. All these affect the indicators of the interest rate risk, because here what happens normally when the stock markets are booming, the rate of interest are going down because more and more funds are going to the market, and less funds are safe in a safe avenues. Then next comes the currency risk. What are the identification parameters? Government action. Okay, any country has a nominal interest rate. Yeah, when this is a basically there is a parity theory. When we shall cover the topic of forex risk, then you will get this point. Inflation rate, purchasing power parity, natural calamities that has a negative impact. If there is any flood or situation like that, then it will have a negative impact on the currency. War, coup, and revaluation, change in the government. Okay, this is very important because foreign investment plays a very big role in the currency risk. Suppose if the government is a FDI friendly, there will be more pumping of money, and by the pumping of money, our currency will become stronger. Okay, and if the government is not FDI friendly, then of course the FDI will try to pump it out the money, then our currency will become the cheaper. Okay, student. With this, I come to the end of my session here. इस चैप्टर की वेटेज श्रुति, इस चैप्टर की वेटेज कितनी है बेटा? सी, as far as weightage is concerned, of course we cannot comment on the same, and because it is a paper setter's freedom, but certainly some questions will be asked from the topic. It does not mean that no question will be asked, but exactly precisely saying that how much weightage is there, it is a bit difficult. As I told you in the beginning of the class, please don't skip any topic, and even I will repeat this every time. All topics are equally important. Okay, students, I am sharing with you my contact number. It is 012030. Okay, student, this is my, I am just writing it in here. This is STD code. Okay, so Pooja beta, you can contact me on the Monday. ठीक है ना? After 10 a.m. up to 5 a.m. p.m. in the evening. ठीक है? So you can contact me. So I will solve what exactly we query. We will discuss the same. Coup means beta, it is basically a revolt by the police or the army, who are the defense who are the persons who are involved in the defense. They become anti-government. Okay, like basically there a coup recently has been in the Myanmar. I think it somewhere around 3 to 4 year back, 3 year back or somewhere, when this there are coup in the army has revolted. Army. Okay. Okay, student. With this, I come to the end of the session. I hope
in these two sessions, you have well understood the concept that we have covered. Moreover, now in the next class, CA Devas Gupta sir will take the class and they will take the topic of capital advanced capital budgeting decisions. So, student, we shall meet there, and of course, soon we shall upload the assignment of the same class. And please attend the classes. And if you have any query, as I told you, you can contact us through the mobile BS app, or we can contact our telephone also. Okay, student, have a nice day. Thank you very much.